something big is changing on March 11th, affecting banks and possibly millions of people. We're looking at why this is happening, what billionaires are doing in response, and how it impacts you. Plus, we'll discuss how to prepare for the upcoming market shift. Stay tuned as we explore the actions you can take now to prepare for the great market crash. In March 2020, banks had a surprising rule. They didn't need to keep any of your money. Yes, you heard that right. Not a single dollar of your deposits needed to stay in the bank. What were they doing instead? They were busy lending out huge amounts of money. Banks were on a lending spree from commercial real estate and cars, often lending 30 to 40% over the sticker price to homes and small business loans. But this all changes on March 11th. In just 15 days, a significant shift is set to happen, and it's not looking good for thousands of banks. This shift could potentially rug pull thousands of banks, affecting hundreds of millions of Americans. How big is this? We're talking about a significant impact on people's financial stability and economy. But what could possibly prompt such a drastic shift in the banking sector? Let's look to the market's titans for clues. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now back to what I was saying. Billionaire moves and economic indicators. The big players like Warren Buffett are not sitting idle. Berkshire Hathaway's company has sold off $28.7 billion worth of stock, amassing its largest cash reserve ever. And he's not alone. Jeff Bezos sold $85 billion worth of stock in just a week. What about Mark Zuckerberg? He sold $500 million worth of stock in the past several months. It's a massive sell-off from some of America's wealthiest and smartest investors. But why are they doing this? It appears they're bracing for a major shakeup in the financial landscape. Remember March 2020 when the Federal Reserve made the unprecedented decision to allow banks to keep zero reserves. This policy cranked up the risk in an already unstable banking system. And it's not mere speculation driving these concerns. Authoritative sources like the Federal Register, Investopedia, and Forbes have all weighed in on the matter. Understanding these billionaire maneuvers is crucial, but how will upcoming changes directly affect you and me, especially in terms of borrowing costs? It's a glaring warning sign. The actions of these billionaires, combined with the looming changes in the banking sector, signal potential chaos ahead. But being informed means we can prepare for what's coming, ensuring we're not caught off guard as financial conditions shift. As we consider these strategic moves, it's crucial to look at the rise in borrowing costs and its implications for individuals and businesses alike. Borrowing costs are on their way up. Despite reassuring words from mortgage lenders, the reality is that loans are about to become more expensive. This isn't just a minor hiccup, it's a significant jump that is on the horizon. With March 11th approaching, there's anticipation of a major event that could alter the course of the economy. This period feels like the calm before a storm, especially in light of recent actions by the Federal Reserve. As borrowing costs begin to rise, it's not just the big banks that need to prepare. Everyday borrowers are also facing a challenging financial landscape. Now, let's dive deeper. How does the end of the BTFP program tie into this looming financial upheaval, and what does it mean for the everyday borrower? Here's something you might not have heard about yet: the BTFP program. According to Bloomberg, this program's about to end on March 11th, and it's a big deal. The Federal Reserve is letting this emergency bank lending program wrap up, and that means banks will soon have to pay more to borrow money. So what does this mean for you and me? Well, if banks are coughing up more to get funds, you can bet we'll see those higher costs too, in the form of steeper interest rates on loans and mortgages. The BTFP was like a safety net for American businesses and families, making sure banks had the cash to cover withdrawals without a hitch. We're looking at a tighter credit scene with this program going away. This could be a game changer for the economy. Looking back, similar situations in January 2020 and September 2008 led to big market tumbles and economic rough patches. These moments in history show us how tight money supply and financial market troubles often go hand in hand. With all these changes on the horizon, what's the real impact on the stock and housing markets, and more importantly, on our wallets? Right now, two big things are making news: the stock market with all the talk about artificial intelligence, and the housing market. Both are facing big changes for different reasons. Starting with the stock market and AI. This area is booming because AI is changing so many industries. But this also means stock prices can go up and down a lot. which could be good for some people and bad for others. Now, think about banks, the big players that help us buy homes and cars. What if they start having problems? This could happen soon, and it's not good news for anyone. If banks can't lend money as they used to, or if they start charging more for loans to save themselves, it means we'll have to pay higher interest rates. For those of us with home loans that can change rates, our monthly payments might go up. And if a bank really gets into trouble, we might start worrying about the money that's in the bank. But there's a silver lining. If we know what's coming, we can get ready. For those thinking about buying a home or already have one, it's smart to look at your loan options now. Try to lock in a good rate before things get tough. And for all of us, it's a reminder to keep our money safe, maybe by saving a bit more. As we keep an eye on the banks, remember being prepared is important. Hard times might also mean opportunities to get a good deal on a home or to think differently about how we save and spend. The housing market is next. It's usually a stable investment, but with interest rates going up and changes in loan rules, it could face challenges. This might affect house prices and make it harder to get loans for buying or building homes. Even though we're hearing about the end of the BTFP program and its impact on the economy, it's not all doom and gloom. Banks have other ways to manage their money, but we should watch out for how AI shakes up the stock market and the challenges in the housing market. When it comes to the stock market and housing, especially apartments for more than one family, things might not be as bad as they seem. Investing in these types of properties could still be profitable. They usually make more money, which is why investors like them. About high interest rates, people think they just make the economy slow down, but it's not that simple. Big companies have actually benefited from higher interest rates since mid-2022. They're saving money on interest and making more from their investments, like in AI. However, for small businesses and most people, higher interest rates means it's more expensive to borrow money. This makes life harder for them. It seems like the Federal Reserve's actions are helping the big companies more than the little guys or the average person. Amidst these challenges, where do we find opportunity? Next up, let's explore how the landscape of investment is shifting under our feet. Higher borrowing costs mean you'll see those interest rates on loans and mortgages start to creep up. This is true for both new loans and those variable rate loans that are pretty common. Are you thinking about sprucing up your credit? Now's the time. Services like GreatCreditFast.com are out there to help tackle any credit report blemishes from foreclosures to late payments. Moreover, in this landscape of climbing interest rates, having your financial ducks in a row becomes paramount. It's not just about sidestepping debt, it's about showing you're a solid bet for lenders. Securing loans at reasonable rates is your ticket to financial stability and growth in a tightening economy. As we edge closer to March 11th, and with the latest word from the Federal Reserve, getting a grip on what's about to change is more crucial than ever. The better you understand what's coming, the smarter moves you can make with your money. Whether it's managing your debt better or making savvy investment choices, now's the time to get your financial act together. This means boosting your credit score and tweaking your money strategy to stay ahead of the economic shifts on the horizon. The picture might seem grim, but how can we armor ourselves financially against the coming storm? We're on shaky ground, perhaps even more than before. Getting credit is going to be tougher, affecting everything from car and home loans to big real estate deals. With higher borrowing costs and harder to get loans, prices on almost everything could drop. This isn't just guesswork. The richest people are moving their money into cash, big time. Look at the Walton family selling off billions in Walmart stock. It's a sign they're getting ready for something big. Janet Yellen and the Federal Reserve are worried too. They're trying to figure out how to keep money safe in banks, big and small. The fear is money moving from small community banks to the big ones, leaving many out in the cold. Remember the bank troubles in March 2020? A lot of cash moved from small banks to big ones like Bank of America and Chase. Now, with the BTFP program ending on March 11th, smaller banks could be in for a rough time. If even a few struggle, people might rush their money to the bigger banks. And it's not just the small banks. Big banks are getting ready for more customers, opening new branches and hiring thousands. At the same time, they're offloading stocks and piling up cash, preparing for whatever's next. This sell-off is happening as talks of government shutdown loom. The U.S. needs to sell a ton of treasuries to keep going, but the big bond market players are hesitating. It's making everyone nervous about what's coming for the global economy. So, what does this all mean for homeowners? It's clear. More challenging times could be ahead, but by being smart and prepared, we can navigate through whatever comes our way. All these individual pieces hint at a larger puzzle. What are the broader economic trends at play, and how do they set the stage for what's to come? Let's find out next. Janet Yellen's spotlight on China's potential move to offload its massive $859 billion in U.S. Treasury holdings amid the Taiwan Strait tensions throws an even bigger wrench into the already complex financial machinery. This isn't just a minor hiccup, it's a major concern. China isn't just any creditor, it's the second largest foreign holder of U.S. Treasuries. Given its heavyweight status in the U.S. Treasury scene, such a significant move by China could send shockwaves through the financial markets. When you piece together the puzzle, big names dumping stocks, the shadow of government shutdowns looming, the U.S.'s ambitious treasury sales plan, and brewing geopolitical storms, it paints a picture of a financial landscape riddled with uncertainties and potential market turmoil. The tension with China isn't just a diplomatic dance, it has real stakes in the economic arena. The U.S. finds itself in a tricky spot, with China holding a significant chunk of its debt. Amid all these challenges, there doesn't seem to be a solid plan in place for how to navigate the potential fallout from China deciding to pull back its treasury investments. This lack of a prepared strategy is particularly alarming against the backdrop of sanctions on Russia and other international tensions. It begs the question, how will the U.S. manage to keep its borrowing costs manageable if one of its biggest lenders starts cashing out? With the curtain closing on the BTFP program, banks are bracing for a hike in interest rates, a change that's bound to ripple down to consumers. This is happening against a backdrop of inflation rates and job growth numbers that are breaking expectations. Jerome Powell, the Federal Reserve's leader, has laid it out pretty clearly. Don't expect interest rates to drop unless we see consumer spending take a dive and unemployment rates climb. But here's the kicker, everything's moving in the opposite direction right now. So what's the big picture? Well, it's shaping up to be a tough ride. Banks facing higher interest rates, climbing inflation, and strong job growth aren't exactly ingredients for cheaper borrowing costs. It looks like more and more people might have to part with their assets just to keep their heads above water. We're at a pivotal moment in the U.S. with the economic landscape morphing in ways we haven't witnessed before. Picture this. The average adult over 18 in America is lugging around $100,000 in debt. That's a massive burden that's setting the stage for some real financial drama. With interest rates on the rise and credit becoming a harder gem to find, falling behind becomes a looming threat for many. The numbers are already painting a grim picture, with a good chunk of subprime credit card users and city dwellers struggling to keep up with their bills. And with borrowing costs expected to jump, this situation is likely to get even tougher. But here's a glimmer of hope amid the storm. For those dreaming of owning a home, there's a silver lining. Thanks to programs from Fannie Mae and Freddie Mac, snagging a duplex, triplex, or fourplex with just a 5% down payment is within reach. This could be a game changer, especially for renters eyeing the long game. With corporations increasingly snapping up single-family homes and potentially dictating rental prices, grabbing a piece of real estate now could not only provide a financial safety net, but also open up a new income stream down the line. Right now, there are a ton of new apartments being built, more than we've seen in 50 years. This means a lot of rental places are about to hit the market, which could make rents cheaper for a bit. This situation is a solid chance for people to think about buying properties that can make them some money, like apartment buildings. If you buy one, you could live in one part and rent out the rest, helping cover your bills or even earning you extra cash. The smart move now is to be careful with your money and think about buying things that can help you save or make money, like real estate that pays for itself. With the market changing, people who are ready that have saved up could really benefit from this. It's all about being prepared, saving your money, and jumping on a good deal when you see it. With these insights in hand, how do we navigate the future? Is there a silver lining for those ready to make informed, strategic decisions? In this mix of tough and good times, being smart and making informed choices is key. For those willing to plan for the future and make smart moves now, there are ways to get ahead, even when things look uncertain. How does this approach sound to you? Heading towards March 11th, there's a bit of a myth floating around that banks are scrambling to grab cheap money from the Bank Term Funding Program before it's gone. But let's set the record straight. Banks have more than one trick up their sleeve to get funding. They can dip into the bond market, drum up funds through the stock market, or even borrow straight from the Federal Reserve at the discount window. So the panic around the BTFP wrapping up might be a bit overblown, as banks aren't just stuck with one option. In summary, the financial landscape is on the brink of a major shift come March 11th, with potential widespread impacts from the banking sector to individual wallets. The actions of billionaires offloading stocks and the end of the BTFP program are critical signals of what's to come. But with the right knowledge and preparation, there's a way to navigate these challenges. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.